Hello and welcome to another Switzer update. And the big story this morning, of course, was the ATO cracking down on work from home Australians. And they could be out of pocket as a consequence of an ATO rule change. Accountants say it could be about $1,300 a year. Could be the typical loss for someone who is working from home and has been claiming tax deductions. Basically, the change means that if you opt to take the easy way of doing it and just go for what you might call a fixed rate claim. It was 52 cents and they are putting it up to 67 cents an hour, but there's a lot less you can claim for. You can still claim some for the actual cost, but the bottom line is this: 2 million Australians claim deductions for working from home before the pandemic. That then soared that figure to 5 million, and something like $20 billion worth of work-related expenses are claimed by Australians, and that's 8.5 million Australians doing it. And the average claim is about $3,000, and I think the ATO will be looking for anyone who's claiming more than that. And I do believe they are trying to reduce the appeal of working from home in terms of tax. The big ATO demand consequence, basically, if you like, is that you have to keep much better records. You have to have the actual hours if you want to claim the real costs from working from home, the tax deductible, allowable costs from home. The new 61 cent rate considers a taxpayer's total deductible expenses for their electricity and gas, phone usage, both mobile and home, internet, stationery and computer consumables. And if you go for the 67 cent method, there'll be no other tax deduction claims possible for these types of expenses. But you can claim something separately, and they include the decline in the value of assets that you use working from home. That's basically depreciation of your computers, your office furniture. You can also claim for repairs and maintenance of these assets. And also, a lot of people will be interested to know this, you can claim cleaning the dedicated office where you are working. Let's go to Wall Street now. They got another bad inflation number, and that was the producer price number. And the Dow ended up down 431 points, or 1.26%. NASDAQ was down 1.78%. And I guess the bottom line is that looking at the job number, looking at the inflation number, looking at the producer price number, put all these together, and it looks very much likely that the Federal Reserve is not going to ease up on interest rate rises. The St. Louis Federal Reserve president, who is on the Federal Reserve Board that ultimately changes US interest rates, says he advocated a 50 basis point interest rate hike at the last meeting, so I guess he'll be reinforcing that. And the Fed boss, Jerome Powell, could easily go for a real shock and awe hit next time they meet if those inflation numbers and the related economic data doesn't start pointing to the fact that inflation is falling at a sufficiently fast rate. Inflation is falling in the US, but maybe not as fast as the Fed will like, and that's why they might go for another one. It's part of the reason why the Aussie dollar's come off the boil a bit, because we got a good unemployment number in the sense that it rose, which means it's good for inflation. While on the other hand, the Yanks are having a bit of a battle with inflation. That's going to be the main story for next week, watching how the market reacts to the possibility that the Federal Reserve might keep raising interest rates at a slightly faster rate than we might have thought a couple of weeks ago. That's my update. Talk to you on Monday.